we should probably look to academia about what is it they say that's actually going to allow you to outperform the market, because we don't see it. And in fact, what we do see is that most of the time, and if you're listening on the podcast, I've got a graphic up that shows a 15-year history of active managers, and only 17% of them outperformed the market. And by the market, I mean the indexes that they voluntarily raised their hands for and said, I'd like to be compared to that. And then 17% of them beat the index. That would be a little bit like Cory. What's the whole purpose of why somebody would hire an active manager?
To
do what?
The market. To beat
the market. Otherwise, I wouldn't need a manager. I would just buy the market. So 17% of them did their job. Over 15 years. You had one job and they didn't do it. I probably shouldn't yell that, Mike. I should yell it like this. You had one job and you couldn't do it. So because you had one job and couldn't do it, now we need to look at what would happen otherwise, and where does return come from? Is there a predictable return that we can anticipate? In fact, even Morningstar ratings have shown that they can't predict the market, that the returns are random performance, even for the 5-star fund managers over a 5-year period following, which is why everybody's stuck in the financial product sales conversation with you, because from their perspective, what they have to do is get you to make good decisions and continue to transact with them. So we have 4 areas where the market actually produces what's referred to in economic circles as a premium. Cory, can you walk everybody through the 4?
Yep. So everyone is fairly familiar with stocks versus bonds. I'm sure if you're listening to this, like, stocks tend to do better than bonds, get more rate of return over time. Bonds are less volatile, so they don't have as much up and down, not as much rate of return. So that's what you can see in the very top. Stocks tend to outperform bonds. I can't actually read what order they're in.
Oh, small cap.
Small cap, yeah. So small cap companies, small versus large. So my favorite example of this is Microsoft. Microsoft in the 80s and 90s was a huge growth stock. No one expects Microsoft to do as much growing in leaps and bounds today as it did back then. Part of it is it's already so big, there's not a lot of room for it to grow into the industry. So, and also it was a much riskier stock to buy way back then. It doesn't seem like it with 2020 hindsight, but all of us can remember all the other companies that were kind of like Microsoft that aren't around anymore. Mm-hmm. Next is that value or profit?
Value. Yep.
Value. Yep. Value companies outperform. So this one's probably the trickiest one of them all, but it's looking at the overall, book value of the asset versus the stock price. So what's the company worth when you actually do that internal analysis of everything it has and everything it owns? And then what's the stock price compared to that? Did you have anything more you want to say about that one? Yeah, it's good for now.
Nope.
And then
let me do profitability. Yeah. It's my
that
favorite.
Was my favorite. That was
Oh, okay. You can do this one. I need to drink some more coffee while I brand our Sound Financial Group mug to our YouTube audience. We should have a merch store.
I know.
Can we launch a merch store, Cory? I think we should.
I'll check with FINRA. I think so. Yeah.
www.merchstore.sfgwa.com. Just kidding. Probably won't be up by the time this podcast launches, but that was just to make my chief of staff super nervous.
Leah's going to beat that one too. So this final one is a shocker. Profitable companies tend to outperform unprofitable companies. Now,
Nobel Prize in Economics for Eugene Fama in 2013, in part because of this theory.
That one out. Yeah. But here's what's amazing is, in the tech boom of the 90s, when tons of companies had revenue but no profit, and their stock prices were going up, up, and up, that premium is still holding true. If you look at the chart, even during that time of unreasonable expectations and pets.com going up like crazy, profitable companies still outperformed unprofitable companies. So it's that simple. There's a lot of other factors, several hundred factors that academics have studied that have some impact on the market, but these are the 4 that have been proven out as predictable, pervasive, always there, and that we can actually take advantage of profitably, which is important.
And that's, we're taking some additional risk. Each of those factors may have some additional volatility. Everyone except profitability actually has additional volatility associated with it. But here's the thing to consider. They all have some additional volatility. And yet, when it's all said and done, we're getting compensated for that extra volatility, for that extra risk. It's not that we shouldn't have any risks in a portfolio. We should have some, and it needs to be appropriate for you. We go into that deeper in some of our other podcasts. More importantly, though, if there's going to be additional risk, we should be compensated for it. This is a clip to our weekly podcast. So if you like this content, hit subscribe, hit the notification bell, and go over to your favorite podcast app and subscribe to Sound Financial Bites so you can get our full weekly show. And as always, if our philosophy resonates with you and you want to chat with me or one of our advisors about our philosophy, see if it applies to you and your family, just follow the instructions in the description below.